Good afternoon, everyone, and welcome. My name is LaLomia. I'm a financial advisor. I want to thank you all for signing up to learn about our year-end tax strategies and ways to minimize your taxes today and for the long term. We're really excited to share some important information about the upcoming election as it relates to your taxes, retirement planning, and investments. I know many of you have attended before, and I'd just like to say thanks. What you're about to hear, it represents the best and brightest thinking from our team here at Turning Point. It's the collective wisdom of over 100 years experience. Turning Point is a registered investment advisor, and you can learn a little bit more about me on this slide. I've been in financial services for over 30 years. I started my career back in the 1980s on Wall Street in New York City. A little bit about the firm. Our home office located in Frederick, Maryland. We're female owned. We specialize with federal employees. That means we know your benefits really well. We have clients from most of the federal agencies from across the entire country. We're fiduciaries. That means we put our clients' best interests first. We get asked that a lot. It's important. If you're looking for an advisor, this is a question you must ask because not every advisor out there is a fiduciary and held to the fiduciary standard. Our website, tpfinancial.com, it's not on this slide, but I'll certainly have it on a later slide. Here's what we'll be covering today, how things are going. Taxes, obviously not a fun-filled topic. We're going to do our best to keep you engaged with some real-life stories of families that we've worked with. A little housekeeping before we get into the meat of the presentation. Many of you know I like to be upfront, tell you exactly what's going to happen here today, so no one's surprised. We've got three basic parts to the presentation. First, we take you through various tax strategies, potential ways to lower your taxes, impact from the election. Next, we'll show how this might personally affect you. There's so many factors that have to be considered. And then we have Q&A. We want to help you understand that there are actions you can take today that can have an impact on your life and your lifestyle in the future. Two things not happening today. One, I'm not here to sell you anything. This is an educational forum. And two, it can be difficult to provide personal financial advice in a group setting like this one. Not to worry. Your participation today, it entitles you to a free consultation with me. I'll tell you how that works a little bit later on if that's something that you're interested in. Let's get into it. And we're going to start and end with the election because I know that's why many of you are here today. And that's certainly much more interesting than the IRS and our tax code. Take a look at this chart. It may actually look familiar to those of you who have financial advisors. It looks familiar because it's similar to the long-term historical graph of the US stock market. It is up and to the right. What you're looking at here is the value of $1,000 invested 90 years ago and what that would be worth over time had you not worried about elections. That last figure, if you can't read it, it's 10 million bucks. Stay invested is a theme you'll hear today, and we have a lot of evidence showing you how and why. I hope this makes a little sense. Let's go a little deeper with some facts. Some of these you've likely heard or seen before. It is seasonally a volatile time of the year in financial markets. And those of you who follow this stuff closely, you know what I'm talking about. And if not, I'm referring to the ups and downs or the roller coaster of a stock market we sometimes experience. This time of the year, and it being an election year, brings about increased volatility. Ignoring the noise is something you'll hear me say more than once today. Please be careful with your news consumption and try not to get caught up or emotionally worked up with all the drama, accusations, slander, promises, and bad behavior that elections create. Ignore the noise enjoy the pullbacks. And most people should simply continue investing through the storm. I say enjoy the pullbacks because that's our opportunity to buy the market on sale. We're going to shift to taxes. Why is it that we all need to have a long-term tax strategy? You will pay more without a long-term tax strategy. Perhaps not this year or next, but it's likely it'll cost you a lot more over the long term. What the heck am I talking about? There are little things you can do today, this year, and beyond to lower your long-term tax bill. Participating in the Roth is just one example. I'll show you some ways and share some stories. Taxes are expected to be higher in the future, and the Roth helps you manage that. Roths allow you to lock in today's low rates and never, ever have to worry about taxes again. When do you do this? Yesterday. I'm serious, because lowering taxes and keeping them low is an ongoing exercise, and you simply cannot start too soon. As for resources, you're listening to me today, and you may have your own tax preparer, and you should be proactive with them. That means not just dropping your stuff off, signing it when it's ready, and receiving a copy of the completed tax return. You must ask questions. Otherwise, there's no value in the service performed. What else can I do to lower my tax bill? Is one simple question to ask. Other resources, maybe other folks like me who present on taxes and offer suggestions. I'm not saying everyone needs a CPA to do their taxes. TurboTax, I've used it. I like it. That has some built-in online resources. I like those. Moving along, long-term tax planning. That involves understanding all of your sources of income during retirement. Those sources of income are going to include your pension, your Social Security, required minimum distributions, sometimes called RMDs. There's Roth income, part-time income, investment income. Some folks have rental income. And then what does your spouse or partner have going on? The understanding I'm talking about are the tax consequences, and not only how it works with different tax brackets, but how that impacts your future Medicare premiums. If you didn't know, Medicare premiums, they currently range between $170 to $700 a month. Depends on your income. The more you make, the more you pay in Medicare premiums. So if you plan well and have a solid source of tax-free income, then you'll likely have lower Medicare premiums. See, the tax-free income, it doesn't impact what you pay for Medicare or how much of your Social Security is taxed. I hope this is sinking in a little and making some sense. Most people don't understand this aspect of tax planning. At the bottom of this slide here, let's talk about the three buckets of money that most people have: taxable, tax-deferred, and tax-free. Everyone's goal, that should be to get as much money as you can into the tax-free bucket. The reality, most people are in the middle bucket, tax-deferred. It's been around the longest, and it offers the immediate tax benefit. So for many people, if you do nothing and simply keep doing what you're doing today, you're going to end up with what we call the government plan, which is paying taxes for the rest of your life at whatever rates they tell you. And I'm talking about your traditional TSP, traditional 401k or 403b. You can plan by acting today and creating tax-free sources of income. The Roth is one of the ways to do this. That can be Roth TSP, Roth 401k, Roth IRA, to name a few. Another way is using cash value life insurance, sometimes called the Super Roth. The choice is yours. You can take their plan and adapt as tax laws change, or you can make your own plan. If you're making your own plan, I'd suggest working with someone who knows what they're doing. I'd like everyone to just think outside the box for a minute and not just what your family will earn this year and the taxes owed this year, but think about the total of all those taxes paid during your entire working career. It's scary. It's hundreds of thousands of dollars, maybe more. What if you could chip away at it, put some dents in it, lower that big tax bill by maybe 50,000, 100,000, $200,000, and have that for some fun retirement money? Getting advice from a financial planner or a tax advisor can have this sort of impact and provide massive savings opportunities with your tax bill. I see it all the time. But for it to work, to maximize the impact, it needs to be done well ahead of retirement. You simply cannot start on this sort of thing too early. Some of you have heard me say before, it's okay to pay our fair share of taxes, but no one wants to leave the IRS a tip. And if you're not proactive with tax planning, it's likely you're leaving the IRS a tip. This next slide, I've got some interesting things on here. We want to put as much as we can on autopilot and have money come out of your paycheck each pay period automatically. That's allocating money to your IRA, your TSP, your 401k, FSA and HSA accounts, 529s, contributions to these accounts that can lower your current taxable income. The HSA or health savings account, if you happen to have one of those, and to be eligible for that, you do have to have a high deductible healthcare plan. Build that up. Use that in retirement to pay for a variety of medical expenses. Think of it as a Roth IRA for medical expenses. Only it's better. It's triple tax-free. It's a no-brainer. Money goes in pre-tax, grows tax-free, comes out tax-free as long as it's used for medical. And it gets even better. The money can be invested. An HSA, again, that stands for Health Savings Account, for the tax deduction now, tax-free growth, and tax-free distributions. Different types of accounts offer different tax strategies, different tax rates. We touched on that. If you have options to take money from different accounts that offer different tax rates, you're truly in your own plan and not the government plan. That's where we should all strive to be. The types of accounts I'm referring to are Roth and traditional IRAs, non-retirement investment accounts, your TSP, your 529, HSA, FSA, bank accounts. I've been a do-it-yourselfer off and on over the years, so I get it. And I'm referring to doing your own taxes. Since my company created our own tax department, I'm continuously amazed at how our CPAs are constantly finding mistakes in tax returns they review. And it's not just from do-it-yourselfers. Professional tax preparers are making mistakes. Our current tax code is set to expire at the end of next year. That means starting in 2026, we would revert to the old tax code, which has a lot of us paying higher taxes. What this means is we all have a little bit of time to work on our own individual tax circumstances. No one's going to be able to predict what our next president or legislatures may do with the tax code. Our advice: stay informed and work with someone that keeps up with this stuff. It can be manipulated. It works with what you tell it, and it is not proactive. It looks back, not forward. DIY software doesn't do the type of tax planning we're talking about. Working with someone you can trust, someone who proactively gives you tax planning advice, that's where we all should be. We have our CPAs engaged in our financial planning process for our clients, and I'm constantly pushing for ideas and recommendations to improve a family's financial situation that addresses the massive long-term tax bill. Let's talk about an example. If an individual makes $100,000 and they pay $25,000 a year in taxes, over a 30-year career, that's $750,000 in taxes. What if we could reduce that? Bring it down to 650 or 600. That's serious money that could be saved, invested along the way, perhaps provide for an early retirement or certainly a more comfortable retirement. Audits I have on the slide, they happen all the time. Everyone should be aware that the IRS never calls. It only notifies by mail. And I'd say get some help if you don't understand your audit. Quick story. One of our clients, they were making major mistakes in their tax life, and they had a professional tax preparer. As I said before, mistakes are common, and getting forward-thinking advice from most tax preparers, it's uncommon. Always ask. Ask for ideas and suggestions. They're just not forthcoming. Here's some examples of what we uncovered. This family wasn't taking advantage of deductions for their medical expenses, including mileage. This family had 3 kids. They were doing well, saving for college, but they weren't doing it the right way. They missed out on their state's generous state tax deduction. Happened to be New York State, which offers a $10,000 tax benefit with its college savings programs. This family had some Roths. They weren't fully utilizing them. We suggested setting up an additional one for the spouse, making annual contributions. Family also had a special needs individual. They didn't have an ABLE account set up. They were missing out on the ABLE account tax benefits. The end result for this client, we were able to save them several $100,000 with the long-term tax strategies that we recommended. And I point this out because I believe each of us needs to take a very close look at our personal circumstances and ask the question, am I overpaying the IRS? If you've been with me before, you know I'm big on the Roth. That's our next topic here. It's one way to incorporate a strategy and manage the uncertainty of what future taxes might look like. Everyone here today should probably have some of their retirement plan invested in its Roth option. If not, you might consider a Roth IRA. And by the way, everyone can participate regardless of your income. If you believe or you've been told you make too much money to have a Roth IRA, you are misinformed. A little used strategy called the backdoor Roth allows high wage earners to have Roth IRAs. I want to make sure everyone's understanding what we're talking about here. What we're suggesting is a Roth IRA, which you would do on your own or with someone like me, or Roth participation through the TSP or 401k, whatever you happen to have. Some people do both, IRA and TSP, and you can do both. Again, with the Roth, we not only get the tax bill out of the way now, we're paying tax on the smaller contribution amount, not on the much larger amount that the account grows to become. And I'll talk on that more in a sec. The Roth is funded with money that's already taxed and it grows completely tax-free. It then comes out tax-free. When you need money in the future, you can use the Roth without having to pay extra taxes. Think about it. If tax rates are higher in the future, and most people believe that they will be, you'll be in a great position to have access to tax-free money. That's the Roth. Now, anyone with a traditional 401k, 403b, traditional TSP, you need a tax solution. And taking advantage of today's tax rates on sale is the way to be thinking about Roths. As I mentioned earlier, in 2026, we revert to the old tax code unless something is done about that. So we all have a little bit of time to execute our own Roth strategy while the rates are low. We're sticking with the Roth, and we're going to talk about conversions, which is something I do every year as part of my long-term tax strategy. I do it because it allows me to lock in today's low rates. Having a Roth removes the uncertainty of future tax rates. The Roth conversion, it's simply converting or moving money from a traditional IRA to a Roth IRA and paying taxes on the amount converted. You pay those taxes when you file. Best of all, distributions from the Roth, they're invisible on your tax return. It has no impact on overall taxable income. The blue line you see on this slide, that's the Roth, and you can see it is considerably more valuable. Here's another way to think about your Roth participation. If you or your spouse or partner have any old employer 401k plans, 403bs, or even an old IRA, you can use those to jumpstart a Roth. You do that by rolling it over to a traditional IRA and then convert to a Roth IRA. Just to repeat, the Roth conversion involves paying taxes now in exchange for not having to pay tax on distributions later. How about if you don't convert? Then what happens? You'll eventually have a massive tax bill because of the required minimum distributions, or RMDs. If you don't convert, you're in the land of RMDs, which is taking out whatever the government tells you to take out, and you're paying taxes on those amounts at current tax rates, even if you don't need the money. As I said, I convert a small amount every year. That's my plan. I want my plan, not the government plan, which is RMDs. Currently, RMDs start at age 73. Soon it's bumped up to age 75, and that's for any traditional retirement plan. We call it the government plan because it forces you to take a certain amount out each year. That's how taxes are collected. Those RMDs are taxed. Roths don't have RMDs because we already pay the taxes up front. The acorn in the tree you see on the slide, the acorn is your contribution portion. We want to pay taxes on the contribution portion, which is what you do when you fund a Roth. The tree, paying taxes on the tree, the acorn goes to a tree. We pay taxes on the tree, which is a much larger amount. That's how things work on the traditional side. Some people like that example. Makes it easy to understand the difference between traditional and Roth. Why not get yourself organized with a financial plan? What is that? Financial planning involves having a team review all your stuff. This is how we do it. And all your stuff that our team would look at would be your income, your expenses. We're going to look at your savings and investments, insurance, taxes, pensions, Social Security, along with all your goals. And we explore what's possible for you and your family. Our team of certified financial planners, they use sophisticated software. They take you through a 3-meeting process. Through that, we learn what's important to you, what questions you want answered, what you'd like to avoid, what your goals are. We then show you what's possible, what's realistic, and when, as well as what's not possible, what's unrealistic. At the end, we provide written recommendations to help you achieve your goals so the plan is successful. That may be early retirement. It could be a more comfortable retirement. Maybe it's travel, philanthropy. Some folks want to fund kids' education, grandkids' education. Your goals can be anything. That's how we do it. That's how most people come to work with us. We call our plan Compass because it provides direction. Now, some common tax-related recommendations that come out of the plans we do for families. It's things like max out your TSP, max out your IRA, HSA. All of these, they lower your taxable income. Grow your tax-free buckets. That's with the Roth, that's with the cash value life insurance. Have a look at your taxable accounts. Make sure those have tax-efficient investment strategies. You get that by using ETFs. That's exchange traded funds rather than mutual funds. A lot of folks get killed with capital gains and distributions because their investments are not tax efficient. It's what you keep that matters, not what you make. Tax loss harvesting is something your advisor might be talking to you about if you work with an advisor. If they're not, maybe we should have a conversation. Roth conversions, we touched on, quick, efficient way to grow your tax-free bucket. And then tax planning integrated with your financial plan, that's essential to lowering the massive long-term tax bill that we've been talking about. We're going to flip back to the election. I've got a few slides on the election as we wrap up. Here is the value of money invested over time and what that would be worth. At the bottom, you see the red, $77,000. Had you only invested during the years when Republicans are president, you'd have that amount of money. The blue is the Democrats, if you only invested during the years in which we had Democratic presidents. And then at the top, if you didn't care and you just set it and forget it, you'd have over $3 million. There's a theme here, folks. We get a little more granular with this slide. Past presidents. What you're looking at is the value of the S&P, how much what the S&P did during the years that our presidents were in office. And most people are surprised to learn that Bill Clinton is the winner. The S&P index was up the most during his years as president. And you can see markets do well during both when either party is in office. Here's another look at the money. Going back 70 years, we invest $1,000. That $1,000 is only invested during the years in which Republicans are president. Over a 70-year period, that 1,000 becomes 27,000. Same thing with the Democrats. You invest $1,000 70 years ago, and it's only invested during the years when Democrats are president, you've got about $62,000. And if you didn't worry about it and plugged in $1,000 70 years ago and just let it ride, that's worth $1.7 million today. What does it say here? Put politics aside, stay invested. That's the theme here, folks. And the last one, which I think is the most compelling, what is the best thing? Well, the best thing is split government, regardless of who the president is. If we have, balance and we have checks and balances, these figures lay out under which scenario the market does best. So I hope that helps. I hope that was a good visualization of how you ought to be thinking about the election and your money. We're close to wrapping up. Some action items. By the way, these slides, they're available upon request. Shoot me an email. I'll have my email address up in a second. We covered what happens when you don't have a long-term tax plan, and that's a larger tax bill. We want to automate and just start at any amount. Getting started and automating is much more important than how much we put in. That's because you're going to have the opportunity to increase that by a dollar amount or a percentage each year. You want to talk with someone. Make sure you have the right account set up to manage taxes in a way that's most tax efficient for your circumstances. Do your financial plan and your tax plan. Are they complementing each other? What does that mean? Are your CPA and your CFP, are they talking to one another about your strategy, your taxes, your goals? Are they trying to be efficient? That's one of the things I love about where I work. We've got all that under one roof. It's completely integrated. Next, you want to make Roth contributions in any and every way you can now. The Roth advantages and benefits, they may not be available to all of us in the near future. And I say that because it's been on and off the government's chopping block. Tax loss harvesting may be appropriate for those of you with taxable accounts. If you have an advisor, they should be talking to you about this. The last one that speaks for itself. A lot of drama out there. Stay away from that. The biggest mistake we see people make, it's not asking for help when they really need it. Fortunately, you have resources. Several federal agencies, they've asked me to be a resource. Please contact me if you need help, if you have questions about anything we discussed today. Got my contact information here on the screen. You can learn more about me and my firm on our website. Connect with me on LinkedIn. I know many of us are already connected on LinkedIn. I promote and advertise these events on LinkedIn. I also push out other relevant content on LinkedIn. The free consultation, early on, I mentioned your participation entitles you to a free consultation with me. If that's something you're interested in, send me an email. We'll get something scheduled. We can talk about what I went over today or anything else on your mind in your financial life. So I hope that helps. If you have questions, send me an email, and you're welcome to share this presentation as well. Thanks, everybody. Thanks for listening. Let us know if we can be of any help. Thank you so much.